Hey everybody, today's October 26, 2023, and today we're going to talk about the stock market, and we're going to talk about the upcoming monthly close and where I see the stock market going in the month of November. Before we begin, please read the disclaimer. You can pause this video as you read it. Okay, so this month, we basically continue the trend downward, right? And in my last video, I was sort of hopeful that we'd hold this Fibonacci level. I said that this level here, I think at the last video I said that, this is the SPY, the ETF that tracks the S&P 500. And I said that where we left out last time was this sort of hammer candle, right? And I said that, if we can hold this level, perhaps we can continue up higher, right? And that's what I wanted us to see. Because I said that we've been in this sideways channel. Let me just get a cleaner chart. We've been in this sort of sideways channel for about a year now. And we finally broke out in basically the spring of this year, right? We finally broke out. So usually when we see a breakout like that, we don't want it to come down and break back in within the range, right? So, but right now we're pretty much breaking back within the old range. So this is definitely considered bearish, but all hope is not necessarily lost, right? The bulls have to put in the work now, right? We've lost not only the Fibonacci level support, but also the 200-day moving average, which are important long-term indicators, right? But on the other hand, we are coming down and filling some of these gaps, right? So that's not necessarily a bad thing. We're coming sort of at the top range, in the previous resistance area, right, of the previous range, year-long range. So we're coming towards like the upper end, right? So what we want to see is we want this part to hold. And usually what the chart trend will do is it'll come down. It'll try to hold the previous resistance as for support, right? And if we're able to hold it, we might see the trend reverse and go up higher. So that's in the short term. What we want to do is obviously we want to reclaim the 200-day, which is this blue line, right? And then we want to reclaim the Fibonacci level here, and then we want to start working our way up. But I also said that as long as this is a lower high and lower low, we have to give benefit of the doubt to the bull, to the bears, right? So in my last video, I said that I wanted us to start pushing up higher and start making higher lows and then higher highs, right? Something like this, right? Where this could have been the first low. But obviously we came down and we just plunged through, right? So obviously things are looking in the short to medium term more bearish. We definitely need the bulls to step in and start to put in higher lows and higher highs to try to reverse this, right? But let's look at and see what other technical data we can get, right? If you see the chart, this is the long-term chart over the last 10 years, right? Things actually don't look too bad in the bigger picture. You can see that we're still in an uptrend, right? We're still in a secular uptrend. We're still above the 200-week moving average. Now, in my Twitter post, I talked about how the 50-week, this is on October 18th, right? 50-week SMA, the 50-week SMA just crossed above the 100-week SMA, right? The silver line above the gold line. So this is technically bullish. But of course, now that the price is going below, that's definitely bearish, right? We want to see the price stay above the moving averages, with the 50-day above the 100-week, the 50-week above the 100-week, and the 100-week above the 200-week, which is the silver, gold, and blue lines respectively, right? So right now we're going down below. Still one more day left in this week, but this is going to be important because is November going to continue down lower? Are we going to retest the 200-week, right? Or are we going to finally are the bulls going to put in some work in reverse, right? Again, to try to figure out what we might see next month, we should look at the monthly scale, right? I remember a couple months ago, around the month of, for the video for the August prediction, I said that I wouldn't be surprised if we saw a red month because we had 5 consecutive green monthly candles in a row. And usually it's pretty rare that we don't get at least a pullback or two. So I thought maybe 1 or 2 months, but obviously this is pulling back a lot more than I expected. But at the same time, looking back in retrospect, right, this is the logarithmic chart. If you look at the linear chart, you'll see that we actually, this breakout above the year-long range is actually a lot steeper than, steeper than usually the direction of the trend. And usually the direction of the trend is a little more stable, right? We have these periods where the market has these impulse move higher and a pullback, and you sort of see this over the last 10 years, right? So in a way, this could be just the pullback after this impulse move up, after we build the base for a year, right? And we can see something like this, the continuation higher. So as long as, in my opinion, as long as we're able to defend at least 3,800, this is like the bare minimum, right? Or at least we definitely don't want to see this. Hold the 200-week and then push up higher if we are to come down lower, right? And of course defend the 50-month moving average, again around 3,800, right? So 3,800, in my opinion, is the next important level, or at least not the next level. That's like the bear. Like if we lose that level, we could plunge into a bear market, right? So there's still some move down. There's still some room down to 3,800. But if you see, look at the longer term chart. Let me just get the SPY back. You'll see that 3,800 is also the Fibonacci support level. So it's funny how these things tend to line up, right? All these different tools tend to line up, and that's actually another signal that these levels of support are also important, because when you have different confluence, different indicators telling you that 3,800 is important, right? Moving averages or just the previous support level and also the Fibonacci level, like all these tools come together. Now the good news is that we're also a little bit oversold right now, right? On the RSI, you'll see that we're hitting 30 soon, and when we hit 30 previously in early October, we had a nice bounce up higher, right? But that doesn't necessarily mean it's not going to continue down lower. This could just be a dead cat bounce before it goes down lower, right? So again, this is what we need to see, right? We need to see the next possible bounce for the next couple sessions. We hold above the 200 week and also, sorry, 200 day and also above this Fibonacci support level to continue up higher. Otherwise, we could possibly get a fake out bounce that could try to take out the support level here, or I guess resistance now, and it could be rejected and go down lower, right? While the RSI pushes up higher and then it continues down lower, right? So those are two scenarios. Either we have a nice bounce soon, which we probably will have since the RSI is oversold right now, but we get rejected under the 200 day and the Fibonacci's resistance level, and we continue down lower, right? Something like that. Or we bounce up higher, bulls put in the work, bounce up higher, come down, try to retest this, probably going to retest the support level and then push up higher, forming higher lows and higher highs, right? Right now we're making lower highs and lower lows, and that is usually the classic downtrend sign, right? And we need to flip that and start making higher lows and higher highs. So that's the technical. Let's look at some of the other indicators. We have fear and greed index in fear right now. So this is telling me that there's really not much more room to come down low. There's still room to go down lower, but there's more upside. So we might see a nice bounce that could last a couple of weeks. Who knows, right? And so there's still a lot of upside in terms of like the sentiment, right? Of course, inflation data has been we had a CPI was going down, right? We want to see inflation go down, but we had sort of a bounce starting from the summer of June, right? And September again was basically stabilized here. But we want the inflation rate to continue to continue on a downward trend, right? Which we saw starting June of last year. We saw basically several months where we just kept going down, but we sort of had a bounce in June. So we definitely want to see this to come down, because if not, then the Federal Reserve will continue probably to continue raising rates, right? And right now we're at 5.33 federal funds effective rate, and as you can see, over the last several decades, we're starting to sort of get back to that point where we're getting back into that to more, I guess, more historically normal ranges, but still higher historically over the last 10 years, right? So the market and the economy is sort of having having a hard time adjusting to this, but in the bigger picture, it is sort of like these sort of levels we've seen these historically in the past, right? It's just that to sort of stimulate the economy, the Federal Reserve, after the Great Recession, at the financial crisis, they basically kept rates really low, like almost 0%, right, for almost 10 plus years. So now we're sort of like having withdrawal symptoms as we start to raise interest rates, and it becomes harder to borrow money, right? So a bit of a credit crunch right now. So, but there are speculation that maybe perhaps sometime next year the Fed will start to cut rates if the inflation CPI continues to go down. If we can start to get a trend reversal for the inflation rate to start coming down, right? So that's what we're looking for. Next one is going to be the month of October, which is available on November the 14th, and this is going to be another crucial one because we want to see the CPI rate come down, right? We've been elevated bounce since June, but as long as we keep staying elevated, we can still see the Federal Reserve possibly continue to raise rates, maybe another 25 basis points. Who knows? But the market does seem pretty optimistic at this point. However, that we could possibly start cutting rates sometime in 2024, and that could be great for the market because the market usually moves inversely proportional to the rate hikes, right? And of course, we're seeing the 10 and 2 and 10-year yields are starting to sort of uninvert, right? So we've been in a inverted yield curve for a while now, right? Usually, you want the yield curve to look something like this, right? Like that. Now we're in an inverted yield curve for about a year now, right? And let me just see. Yeah, we became inverted. Actually, over a year now, since the summer of last year, right? We went below this line. So we're starting to see the yield curve uninvert, meaning it's moving back into positive territory, still in negative territory, but it's starting to move. So we're starting to see that the longer dated yields starting to move up a little bit, and eventually we'll see the short dated yields come down a bit, right? And we'll see something like this. That's the normal. But people are worried about this because historically, when the yield curve becomes inverted and then uninverts, a couple months later we'll see a recession, right? So which is a shaded area. So every time we go below and then uninvert, we see a shaded recessionary period, right? So that's what the market is worried about. So that could be people trying to maybe they're starting to see the yield curve uninvert and they're trying to front run a possible recession next year, right? Which is another reason why we might be seeing the price canal. Ultimately, I think it's both combinations of the fundamentals and technicals. You know, both the possible fear of recession next year, possible fear that inflation might take a lot longer to cool, and that the Fed might have to raise rates for a longer period of time, or at least hold the rates at this level, right, above 5%, a lot longer than people expect. But also another combination of just the incredible rally that we had this year, at least up to the summer. Maybe we're coming down, pulling back a little bit before we go up higher, but yeah, for now, we really need to watch the chart and see not only the data next year, I'm sorry, not next year, the data for the inflation report next month, but also what the Fed might do in reaction to that, right? So those are two crucial fundamental factors. On a technical basis, like I said, we are right now in a bearish posture, making lower highs and lower lows. We're also below the 200-day moving average, this blue line. We're also below the Fibonacci support level. So a lot of support levels that we broke in below. And we really need to get back above, right? At least the most positive thing we can say is that we are at the resistance level of this 1-year trend area, right? But we really need to hold this level. We don't want to fall back within this range. Otherwise, I can see us going all the way down, retesting perhaps 3,800. So 3,800, again, a crucial level. 3,800. If we break this level, I can see us going down even more. So we definitely want to at least hold this level. Best possible case scenario, hold the level we're at, right? 4,000 SPY, hold that level, and then go back up and try to reclaim the 200-day moving average, the Fibonacci, I guess, support trend resistance level over here, and then start to make higher lows and higher highs, right? For the month of November, starting from there. So November, I think, is going to be a crucial month, not only for the CPI data, Fed response, but also because this is where the bulls need to put in the work and start absorbing some supply, right, and defending this level. If we lose 4,000, I can see us going down to 3,800. So I will come back. So that's what I'm seeing for the month of November, and I will come back at the end of November to provide a update for what I think we'll see in December and so on and so forth. But yeah, hopefully we have better economic data, and hopefully the charts will look a little better next time, but we'll see, and I'll definitely update you as the charts and the economic data comes out moving forward. If you found this video useful, helpful, or informative, please like this video, leave a comment below, and subscribe for updates. Thank you for watching this video. I appreciate your support. Thank you again, and have a great day.